It's a great area in terms of its geological significance. It's a rich area. It's in a safe jurisdiction. And because up until recently, it lacked the infrastructure. So you now have roads and power lines and you've a deep water seaport. So you've got this incredible geological gold, silver, copper mining camp. But it was essentially pretty remote up until the last few decades. So, and then, I think jurisdiction matters. I think that, where a project lies, there are projects that are in countries where, you look at what's happening to Barrick right now in Mali, it's jurisdiction matters. So it's in Canada, it's high grade, it's big, and up until recently, it was very, very difficult to get to, which made it very expensive to operate. Look, I'd like to think of like a sports analogy. We were the worst team in the league, and we've slowly, systematically over the last few years, first in the coaching staff, we've built up, we've picked the right players in the right positions, and that's led to some success on the ice. And now we're in the playoffs, and we're ready to make a championship run. We want to go get that Stanley Cup. And how that's played out for Dolly Varden is we started off with a couple of small. Two of them were past producing mines. The price of silver was $16, so it was really hard to make money in that price environment. Gold was $1,300, and we had 7,000 hectares of ground. Fast forward, we've got 100,000 hectares of the most prospective ground in the Golden Triangle. It's underexplored, and we've gone from having 2 past producing mines. We now have 5 past producing mines. Our mineral inventory has gone through the roof. We've gone from 40 million ounces of silver to over 150 million ounces silver equivalent. We've added a lot of gold into the system. We've put over 135,000 meters of drilling into the property. So we've made discoveries, we've de-risked. We've been very, very, very active. And along the way, we've picked up some incredible supportive shareholders, people like Eric Sprott, people like Hecla Mining, institutions like Fidelity. So it's been a lot of hard work. It's been a little bit of luck. It's been making opportunistic acquisitions, and it's been on the back of incredibly generous and supportive shareholders. Yeah, so there's a long history. Hecla's been a shareholder for a long time, and Hecla used to be run by Phil Baker. Phil Baker ran the company for 23 years. Hecla's a long storied company. It's been listed on the New York Stock Exchange for 135 years. And so, and the company's had incredible success. It's one of the go-to silver names on the board. And, as they think about their pipeline and their growth into the future and think about replenishing mineral inventory, they have made strategic investments into companies where they see a potential for a pipeline project. So I think the 15% they own in Dolly Varden represents their hope, their belief in the potential of our project. 12.5% was through equity investments. So that's them putting, $20-30 million of hard cash into the company's coffers so that we can go out and we can make acquisitions and we can make discoveries, drill holes, build up the team, build up the resource, de-risk the project. That last 2% that they've come in to own to go from 12.5% to just under 15% is through the divestment of a neighboring contiguous project. So they had a big prospective piece of ground that's next to us that contained a past producing silver mine called the Esperanza mine. It also contains a parallel trend called the Iliad's trend. It's a big project. And I think what our team has demonstrated is we have the ability through our knowledge of the area to make discoveries. So I think the rationale is as they're focused on their business, as they're focused on Casa Berardi and Greens Creek, Lucky Friday, Keno Hill, and all their other exploration projects, this was a way for them to increase ownership, but not have to divert funds into advancing the project. Well, I think it's really accurate, and we don't have to look far back. But if we just look at the last 30 days, the silver price saw a low of around $31, $32. Our share price was down in Canadian dollar terms at around $3.50 a share. As silver has broke above, and $32.50 is a very important level. $32.50 is a level that silver has been, has really essentially been below since 2012, right? So, and that has acted as some major resistance. And now that we're above $32.50, and this now looks like the new support level for silver. And as we start now breaking above and putting in, decade highs in the silver price, we've gone through 34, through 35, we're through 36 today for the first time. in over a decade. The share price at Dolly has gone from 350. I think we traded as high as 515 yesterday. That is a big move in just a couple of dollars in the price of silver. And I was telling you about this technician that I took in a presentation in London at a Raymond James Silver conference, and he talked about if we can get through 36, the next level of resistance is 40. So if we think about the fact that Dolly's put on $1.50 a share, would that move from 32 to 36? What would it do if it went from 36 to 40? And so, what's exciting, the other way I look at these silver companies, and there's 10 primary silver producers. Let's assume their average all-in sustaining cost is about $20 per silver ounce. Well, when the silver price is $25, they're making $5 on every ounce they produce. It goes to 30, they're 100% more profitable, and so on and so on. So every $5 move in silver is very, very significant. And that's where the leverage comes in. And that's where, when you look at a company like Dolly, we were trading at pennies an ounce in the ground. Today, we're trading at dollars an ounce in the ground. And if the more ounces we can get, if we can start multiplying, that by a few 100 million ounces in the ground, that's where you get a real opportunity for a silver investor, a silver speculator, somebody. And I really think that we're at a time right now where on the silver to gold ratio, there's been 3 times in history where that ratio has gone to 100 to 1, greater than 100 to 1. And we were in one of those moments in the last 30 days. Today, right now as we speak, it's 92.5 to 1. So silver is starting to outperform gold. This is, typically every time that ratio has gone up to 100 to 1, the play has been to go long silver and silver equities, and they've bounced back quite nice. So, typically what I've witnessed in the 22 years that I've been working in the mining industry and really, acutely following precious metals and precious metals equities is first you have the price of gold move, and then there's a trickle down to the gold equities. And then you typically, after the gold price moves, you have silver move, and then you have the silver equities. And it's typically the silver equities that are, give investors the most leverage. And so this is, for anyone looking to get exposure to the space, you're looking at a historic opportunity to invest in silver at close to 100 to 1 silver to gold ratio. So I want to go back a little bit. I want to go back to 2016.
Yeah, okay.
In 2016, we had the gold price move from 1,000 to 1,400. And we had a pretty good junior market. The TSXV had made a big move, and there was a lot of enthusiasm and flow of funds into some speculative juniors. The problem in 2016, the difference between 2016 and 2025, is you have a new phenomenon today, which is Agnico Eagle is making $300 million a month free cash flow. Okay? They were not making $300 million even in a quarter back in 2016. So the biggest fundamental difference is as the gold price bottomed at 1,000, and as we are now, at 3,400, in that 9-year period, okay, there's been a tremendous wealth creation. Like you look at where some stocks were, like Franco-Nevada, I think they're around $250 a share today, in and around that ballpark. So you've had all these equities move up multiples, the big ones, and they're spitting out lots of cash. So we're in an environment now where a company like Agnico is going out and they're putting a lot of money into juniors. They put a lot of money into Continental Gold in Colombia. They bought O3 in Quebec. So because you've got this record wealth creation at the top, there's all this money that's now. So what if you go back to 2016? There was nobody competing with the speculators. The corporates were just getting their house in order. They were paying down debt. They were selling gold at $1,000 an ounce. So the difference this time, the reason why every correction has been bought quickly is we are out of the stealth phase of initial part of the market. We are now in stage 2, which is the longest and strongest. Stage 3 is the blow off top, the euphoria. It's where the most money is made and the biggest money is made, but it's a short part of the cycle. We're in this middle inning. And this is a great time to be in the space. And that's why you have all this strength. And, why I'm so confident today is we're starting to see other things happen here. For example, you go back to 2016, the US dollar was in a strengthening period. From its lows of say 2008 at 72 on the dollar index, what the Dixie just did recently here is it lost 99, which is a critical element, a critical support level where it lost, and that next level should have it come down to around 96, 95. And so if you think about gold, silver, copper, these are all priced in dollars. A 350% move amongst the high caliber gold equities. This is really day one. This is the beginning of a new shift, and so I really think to answer your question, look, we're in such a unique time where these majors are now going to play catch up quickly. They're going to secure their future mineral inventory, and you're going to see a flurry of M&A activity, and we're seeing things that like look at stocks, companies like Discovery Silver, Integra, Avino, the junior producer category. There's a company in the office here, West Red Lake Gold Mines. The 6 months they've been on an absolute tear as they turn on the Madsen mine. So where the market was it was hiding out in the royalty space. Where the market has been more recently was playing the large caps, the best in class, the Agnicos, the Alamoses. In the first 6 months of the year, the place to be was the junior producer category. And what's next? It's going to be the unfunded developers. The unfunded developers, Agnico and First Majestic are trading at 2 times net asset value, yet there's unfunded developers that are trading at 0.2 times net asset value. So for those who are looking for value, they're going to come down and start positioning in that tier. And so, I think of a company like Dolly, where we've got this large resource, it's high grade, it's in a safe jurisdiction, and we've played a lot of catch up in the last 2 weeks in terms of share price, but we're still lower today than where we were in October. And so I think that there's still a tremendous opportunity. And then considering company specific events like the fact that we were able to go from 15,000 hectares to 100,000 on 2% dilution. So the fact that we are taking advantage of an even lower tier in the market, the deals we did with the sub juniors, the nano caps, where we picked up projects that were once valued at $100 million and we bought them for $1 million, right? I'll give you one example. Porter, Idaho, past producing the highest grade silver mine in the Golden Triangle. We bought it for 8.5 cents an ounce in the ground, and we're trading at over $2 an ounce in the ground. That's an accretive deal. So that has been how we've built the company. It's been on looking for accretive opportunities where we can use our relative strength and to grow.